So, what happens when two companies decide to become one? They don't just merge their offices and their teams, they have to merge their entire financial stories, their balance sheets, their histories, everything. But how do you actually do that? It's not as simple as just adding two columns of numbers together. In fact, the way you choose to tell that new financial story can completely change the future of the new company.
And that really gets to the heart of the matter. It's the first big question an accountant has to answer. Is this a true partnership, a marriage of equals where both companies are combining their forces? Or is it really a strategic buyout, where one company is pretty much just buying the other one? The answer to that question changes absolutely everything that comes next.
All right, so in the business world, there's a big term for all of this: corporate restructuring. It's just a way for companies to reorganize themselves to become more profitable, more efficient, and, better at competing. And one of the most common ways they do this is through amalgamation, literally bringing two companies together to make one.
And believe me, this isn't just about shuffling some papers around. This is a fundamental change to the very DNA of a business. It often happens because of a buyout or maybe just the strategic need to grow and adapt to the market. Amalgamation is a really key tool in this whole restructuring toolkit.
Now, to make sure everyone's playing by the same rules when they tell this new financial story, there's an official rulebook. In India, that's Accounting Standard 14, or AS14 for short, and this single document presents every company with a critical choice, a real fork in the road that will define the financial future of the brand new entity.
And here's the absolute crux of it. AS14 basically says, look, you've got two choices. That's it. When you account for this amalgamation, it's either going to be treated as a merger or it's going to be treated as a purchase. This isn't just about choosing a word. It fundamentally alters the balance sheet from the very first day.
So on one path, you've got the merger. The best way to think about this is like two streams flowing together to form a single, bigger river. The history, the values of both companies, they're all preserved and combined. But on the other path, you've got the purchase. This is totally different. Here, one company is clearly the acquirer and the other is being acquired. It's a transaction, a straight-up buyout.
Now you might be thinking, okay, I'll just pick the one I like, but it's not that simple. The rules are super strict. To even be considered a merger, a deal has to meet all 5 of these conditions. We're talking everything. All assets and liabilities are transferred, 90% of the shareholders have to come along for the ride, they have to be paid in new shares, the business has to continue, and you have to use the original book values. If you fail to meet even one of these, just one, the rulebook automatically shoves you down the other path. It has to be treated as a purchase.
All right, let's go down that first path. What happens when a deal actually ticks all 5 of those boxes and gets treated as a true merger? Well, the key word you need to remember here is continuity.
The method they use is called the pooling of interests method. And the name tells you everything you need to know. You're simply pooling everyone's interests, all their resources. You take the assets, the liabilities, the reserves from both companies at their original book values. That's the price they were on the books for. And you just add them together.
Look how straightforward this is. If Company A has assets on its books for, say, 10 million, and Company B has 5 million, guess what? The new combined company simply shows assets of 15 million. Same thing for the reserves. 2 + 1 = 3. It's literally just addition. The financial history of both companies just continues on together.
Okay, so that was the easy path. But what about the other one? The path you're forced down if you fail even one of those 5 conditions. This is the purchase method, and this is where things start to get a whole lot more interesting.
The purchase method is a completely different ballgame. We are no longer just pooling old historical values. This is a transaction. The acquiring company's buying the other company's assets and liabilities. And here's the key. It records them not at their old value, but at their fair value on the day of the deal.
And this concept of fair value is the real game changer here. It's not about what you paid for a building 20 years ago. It's about asking, what is this building, this patent, this piece of machinery actually worth in the open market right now, today? We are essentially throwing out the old history books and creating a brand new valuation from scratch.
So if we're calling this a purchase, then there has to be a price, right? How do accountants actually calculate the official price tag for the deal? And maybe more importantly, what happens when the price you pay doesn't perfectly match the value of what you actually get?
That price tag has an official name, purchase consideration.
It's basically the grand total of everything the acquiring company gives to the shareholders of the company it's buying. That could be new shares in their own company, cold hard cash, or even other assets.
Now, the rulebook, AS14, gets really specific about this. The price is only what's paid to the owners, the equity and preference shareholders. So if the buying company also agrees to pay off the old company's debts, that's handled separately. It's treated as taking on a liability, not as part of the purchase price itself. It's a subtle but really critical distinction.
Okay, let's put some numbers to this to make it real. Let's say, in our example, after you add up the value of all the new shares given to both the equity and preference shareholders, the total purchase consideration, the price paid, comes out to 6 lakh and 7,000 rupees.
Okay, so they paid over 6 lakh, and here's where it gets fascinating. When the experts came in and valued all the actual things they got, the buildings, the inventory, all the net assets, at their current fair market value, it was only worth 5 lakh and 50,000 rupees. So wait, why on earth would you pay more than what the identifiable assets are worth?
Well, that gap, that extra money, it doesn't just disappear. Accountants give it a name. It gets recorded on the balance sheet as a brand new, intangible asset called goodwill. This represents the premium you paid for all the stuff you can't put a price tag on, things like brand reputation, customer loyalty, or future growth potential. It's basically a payment you make hoping for future income.
So let's take a step back. We've got these two totally different paths that lead to two totally different looking financial statements. But why should you care? Why does this accounting decision, made right at the beginning, matter so much down the road?
Let's just put them head to head. The merger path gives you this clean combination of histories. The balance sheet just looks like a smooth continuation of the past. But the purchase path, wow, it creates a brand new financial reality. Assets get revalued, and you can suddenly have this huge new asset called goodwill just sitting on your books.
But that goodwill isn't free money. There's a huge catch. The rulebook says you have to amortize it, which is just a fancy accounting way of saying you have to slowly write it off as an expense over its useful life, usually about 5 years. So, for the next 5 years, that goodwill you just created is going to be an annual drag on your reported profits, even if the actual business is doing great.
And that's really the final big idea I want to leave you with. This isn't just some boring exercise for accountants. If the choice between accounting for something as a merger versus a purchase can literally create a multi-million-dollar asset out of thin air that then reduces your profits for years to come, you can bet that the people making the deal, the CEOs, the bankers, are thinking about these rules from the very first conversation, structuring the entire deal to tell the financial story they want the world to see.